Hey everyone, and welcome. Today, we're going to dive into a question that gets right to the heart of how we value companies. We're going to look past that big, flashy number you always see on the news to uncover what a business is really worth. So let's jump right in. Okay, let's kick things off with a little puzzle. Imagine two companies that, on the surface, look like identical twins. Same stock price, same market cap. But underneath, one is buried in debt while the other is sitting on a mountain of cash. So, are they truly worth the same? Well, the short answer is a big nope, and we're about to find out exactly why. To get to the bottom of this, we have to start with a number everyone sees first, the surface level value. And that, of course, is market capitalization, or market cap. It's the metric that gets flashed across financial news channels all day, every day. Now, the math here is super simple. You just take the company's current share price and multiply it by the total number of shares out there. So if a company has 10 million shares trading at $50 each, its market cap is a cool $500 million. Yeah, it's really that simple. You know, what market cap really tells us is what the public thinks a company is worth. It's the collective opinion of all investors, boiled down into one single number. It's so important that huge indexes like the S&P 500 use it to decide how much influence each company has. But here's the catch. That is not the whole story, not even close. To get the real story, you've got to dig a little deeper. And this is where the pros separate themselves from the crowd. Let's talk about the key to a much more complete financial picture: enterprise value. Think about it like this. If you were going to buy an entire company, you're not just buying its stock, right? You're also inheriting all of its problems, including its debt, which you're now on the hook for. But on the bright side, you also get to pocket all its cash. Enterprise value takes all of that into account. And this is where the formula makes perfect sense. You start with the market cap. Then you add the company's total debt because, hey, that's your problem now. You have to pay it off. And then you subtract the cash because, well, it's like getting an immediate rebate on your purchase. It lowers the real price you paid. Okay, so enough with the theory. Let's see how this actually plays out in the real world. We're going to go back to those two twin companies we talked about at the beginning and run the numbers. And here they are, Company A and Company B. Look at them. Based on market cap alone, they're identical. Both valued at a nice, round $500 million. If you stopped right here, you might just flip a coin, right? But now, let's pull back the curtain. Whoa. Okay, Company A is carrying a hefty $200 million in debt with only $50 million in cash. Meanwhile, Company B, totally debt-free and sitting on a huge $100 million pile of cash. Suddenly, they don't look like twins anymore, do they? So let's calculate the true cost of Company A. You take its $500 million market cap, you add that $200 million in debt you now own, and then you subtract the $50 million in cash you get. The real price tag? A whopping $650 million. Way more expensive than it looked a second ago. And now for Company B. We start with its $500 million market cap, add, zero debt? Love to see it. And then you subtract that beautiful $100 million cash pile. Its enterprise value is just $400 million. And that is the big reveal. Even with the same market cap, Company B is fundamentally a much cheaper and more financially solid business to buy. So, here's the simple rule of thumb. When you see an enterprise value that's higher than the market cap, like with Company A, that's a huge clue that the company is carrying a lot of debt. But when the EV is lower than the market cap, like with Company B, that's a fantastic sign that the company has a really strong cash position. So how do professional analysts actually use this? Well, they don't just stop at the number itself. No, they take it one step further and use it to create some really powerful tools to compare different companies. Two of the most common ones are EV to EBITDA and EV to revenue. Now, EBITDA, okay, that's a mouthful, but just think of it as a rough proxy for a company's operating cash flow. Using these ratios or multiples lets you compare different companies on a much more level playing field, kind of like an apples-to-apples comparison. And this EV to revenue multiple is especially handy. Think about a young, high-growth tech company. It might be growing like crazy, but it isn't profitable yet because it's pouring every single dollar back into expansion. Its earnings might be zero or even negative. So how do you value it? Well, you can look at its enterprise value relative to its sales. It gives you a great way to gauge how the market values its growth potential. All right, let's bring it all home. After all this, what's the one big idea you should really walk away with from this explainer? It really all boils down to this. Market cap can be seriously misleading. It's just a starting point, a piece of the puzzle that completely ignores the reality of a company's balance sheet. Enterprise value gives you that full picture. It shows you the true cost of a business, and that is exactly why the pros rely on it. So now you know how to look past the headline number and see a company's real price tag. It kind of makes you wonder, doesn't it? What other obvious numbers that we see in finance every day are hiding a much deeper, more interesting story just waiting to be uncovered?